Hello cosmonauts, many of you are worried about the future of crypto prices. The fact is that some less than encouraging chart signals are surfacing. We can neither say we're in an uptrend or on support. And not all of you are comfortable with the idea of suffering another minus 30% down leg. Personally, I'm prepared to take it because I take a much longer term view than most of you. Yes, because you look at charts, for example, whereas a chart with a 1-year or 2-year history isn't going to help me know whether to unstake my cryptos that I want to hold for 5 years. I think we'll all agree on that. I'm making this video because I want to add a few more strings to the bow of the cosmonauts who unstack their portfolios in anticipation of a market dump. Even though I'm not one of those cosmonauts, I have a high return strategy and above all a neutral delta to offer you so that you don't have to panic about the future price. If you're not comfortable with what you have in your portfolio in the short term but still have a long-term conviction in the assets you own, then this video is for you. And the best part of this strategy is that it doesn't require you to unbond your tokens, which has plenty of advantages in terms of returns and making yourself eligible for airdrop. Let's move on to explaining the strategy. This is a strategy that aims to benefit from staking rewards and financing rates while retaining no exposure to the underlying market price. This strategy consists of holding a long buy position on an asset while simultaneously holding a short sell position on a per platform for the same asset. For example, if you have $100 in a long position on Atom in staking or liquid staking and $100 in a short per position on Atom, then you are not exposed to changes in Atom's price. That's the beauty of this method, which allows traders to take advantage of market conditions while remaining neutral in terms of price when there are more uncertainties. With Atom's perpetual LEVANA market and Stride's liquid stacking, it is possible to use the platform's funding rates, as well as Statum, to potentially achieve a high return while maintaining market neutrality. The financing rate on LEVANA is the key to this strategy. When the open interest, the financing rate for buyers, is higher than that for sellers, the seller's financing rate becomes negative and the buyer's rate becomes positive. In the scenario below, this means that short traders receive a fee for holding their position open. As we can see, there are more long positions than short positions in this scenario. In order to continue to receive financing fees, we need to ensure that the total open interest short is slightly less than the open interest long. This means that we must not open a position greater than this figure. Bear in mind that as the total amount of short open interest continues to grow, the funding charges paid to short position holders fall accordingly. Once we have understood how to derive returns from perp short positions, let's look at what interests us most today, i.e. hedging. How to hedge with a short position. This will allow you to profit from every drop in Atom by hedging the spots you hold. To make the position neutral on the market, you also need to buy an amount of Statum provided by Stride equivalent to the size of the short position you have. For example, $10 with leverage times 10 equals a position size of $100 to have no exposure to Atom price movement. But if you're watching this video, you probably already have some Atom or Statum stored. So all you need to do is take a short position with the appropriate leverage depending on the cash you have to deploy on LEVANA. So all that's left is to move on to risk management. Although this strategy may seem attractive, it is essential to understand the associated risks. The biggest risks for this strategy are liquidating or taking profit on a short position at an inopportune moment while you are still holding the balancing Statum, which means being exposed to price movement, which means that the leverage on the short position must not be too high. To reduce liquidation risk, going down to a leverage of ×5 or ×2 means less management of the open position. The other risk is that the financing rate may fall or even reverse, i.e. a negative APR on your short perpetuity position before the strategy has made sufficient profits. Finally, borrowing costs are an ongoing cost for the short position. This cost can be reduced by lowering the take profit price slider. This is a compromise between the cost and the risk of making a profit on the short position. In conclusion, as with any strategy, it is crucial to start small and limit your exposure to risk. Keep a detailed record of your trades and the performance of your strategy over time. This will enable you to identify recurring patterns or trends and make more informed decisions in the future. Furthermore, never risk more than you are prepared to lose. This may sound cliché, but it is particularly relevant when it comes to leverage and complex strategies. Although this strategy offers you the opportunity to achieve high returns while remaining neutral with regard to market volatility, it is important to understand all the mechanisms and risks before taking the plunge. Stay informed and ask all your questions on our Cosmonauts Discord or Twitter personally. I mainly use these hedging strategies when I have on-chain data that encourages me to do so, like for example today when we had $2 million of osmosis that was released on the market due to an unbonding, or at UME, we can see that there is a developer from the osmosis team who was almost liquidated for more than $2 million. These are times when I try to hedge against the market. I've been hedged on osmosis for a week now, and I'm quietly getting my returns while remaining neutral on the price of osmosis, which is a big part of my portfolio. I hope you'll join us on our Discord. In the meantime, trade well, take care, and see you next time.